You've probably seen advertisements for brokerage apps that promise free trading. No commissions, no trading fees, no cost to buy or sell stocks. At first glance, that sounds like a great deal. But it raises an obvious question. If trading is free, how does the broker make money? The answer is simple. Let's find out how. Trading might be free for the user, but it is not free for the system. Brokers still earn revenue through several different mechanisms that most beginners never see. Let's walk through a few of the most common ones. First, there's something called payment for order flow. When you place a trade through your brokerage app, your broker decides where that order gets sent. Often the order is routed to a market maker. Market makers are large firms that specialize in matching buyers and sellers. In some cases, those firms pay brokers for the right to handle those orders. This is one of the ways commission-free trading became possible. It doesn't necessarily mean you're getting a bad deal, but it does mean someone else in the system is still paying the broker. Another way brokers make money is through the spread. Every stock and ETF has two prices. A price buyers are willing to pay and a price sellers are willing to accept. The difference between those prices is called the spread. When trades happen, that difference becomes part of the transaction. Most of the time, the spread is small. But when millions of trades occur, those small differences add up. There is also revenue generated from idle cash. If you deposit money into your brokerage account but haven't invested it yet, that cash may earn interest. The broker may share a small portion of that interest with you, but the broker can also earn interest on the same money. Another area where brokers earn revenue is through optional services. Some apps offer premium features. These might include advanced charts, market research, or faster market data. Users who want those tools pay a monthly subscription. Margin is another major source of revenue. Some brokerage platforms allow investors to borrow money to buy more investments. This is called margin trading. When someone borrows money to invest, interest is charged on that loan. That interest becomes revenue for the broker. Margin can increase gains, but it can also increase losses. This is why many beginners avoid it entirely. Now here's the important takeaway. Commission-free trading is not fake, but it is also not truly free. It simply means the broker earns revenue in ways that are less visible to the user. Understanding this helps you see why brokerage apps are designed the way they are. More activity means more trades. More trades mean more opportunities for the system to earn revenue. This is why apps often highlight trending stocks, price alerts, and frequent notifications. Those features are designed to encourage engagement. But successful investing does not require constant activity. In fact, many long-term investors make fewer trades, not more. The key point to keep in mind is awareness. When you understand how brokerage platforms work, you stop assuming that free means there are no incentives involved. Instead, you start thinking about how the system operates and how your behavior fits into it. A brokerage app is simply a tool. It gives you access to the market. But like any business, the company providing that tool still needs to make money. Understanding that relationship helps you use the tool wisely. And that awareness can make a bigger difference than most beginners realize.